Most of you have probably flown JetBlue, or at least you recognize the distinct brand, right? But who exactly is this company at its core? Beyond the blue planes and the catchy ads, JetBlue Airways was founded relatively recently, August 1998, by David Gary Neeleman. It's headquartered in Long Island City, New York. So while it's been around for, over 2 decades now, it's still younger than some of the really entrenched legacy carriers. And that definitely influences its strategic approach.
And what's particularly fascinating about JetBlue's business model, what truly sets it apart in a, let's face it, crowded industry, is its unique position as a low-cost airline that, surprisingly, emphasizes high-quality service. They really carved out a niche. They didn't just focus on getting you from A to B as cheaply as possible. They stood out with perks that were, well, pretty uncommon for budget carriers when they first launched. Things like assigned seating, individual in-flight entertainment screens, complimentary snacks.
Right, I remember that being a big deal.
Exactly. This strategy aims to bridge that gap between truly budget travel and a more premium experience, which, as we'll definitely see, is a tricky and often very costly balance to maintain in the airline industry.
It certainly is a delicate balancing act, trying to offer more for less. And despite that, that nuanced model, their reach is quite impressive. They serve approximately 100 destinations, stretching across the United States, of course, but also extensively into the Caribbean, Latin America, Canada, and even across the Atlantic to England now. So they've definitely expanded. They have a significant international presence beyond just their initial North American base.
Yeah, and to support that broad reach, their fleet primarily operates a mix of aircraft from Airbus, including the A321, the A320, the A321neo, and also Embraer E190 jets. This blend, it allows them flexibility in terms of route capacity and efficiency.
It makes sense.
From an operational perspective, the company functions primarily under one overarching segment, air transportation services. Pretty straightforward. And from a revenue standpoint, the majority of that revenue, their core business strength, it stems from their domestic and Canada segment. In terms of sheer scale, they're a substantial operation, employing, 22,793 people. That highlights their significant contribution as an employer in the industry.
Okay, now let's translate all of this operational identity into their market performance. Let's look at the numbers as of August 15th, 2025. At last close, JBLU was trading at $5.22. It showed a positive change of 14 cents on that particular day, which translates to a 2.76% increase. Now, a positive single-day movement like that might catch an investor's eye, right? Suggest some immediate momentum. But for a true deep dive, that's just the surface, isn't it? What's really underneath that daily movement?
Precisely. Yeah, while a single day's uptick is nice, to truly understand a company's market position, we need to dig deeper, much deeper. JetBlue's market capitalization, which is the total value of all its outstanding shares, stands at $1.90 billion. This gives us a sense of its size within the industrials airline sector. Okay. However, it's absolutely crucial to also look at its enterprise value, which is significantly higher at $8.25 billion. That's a massive difference.
Wow, $1.9 billion market cap, $8.25 billion enterprise value. That's a striking disparity. Why is that difference so profoundly important, especially when we're analyzing an airline like JetBlue?
This is one of the most critical distinctions, especially for capital-intensive industries like airlines. Enterprise value, or EV, provides a much more comprehensive measure of a company's total value because it includes not only its market capitalization, but also its total debt, any minority interest, preferred shares, and then it subtracts its cash and cash equivalents.
So it's the real cost to buy the whole thing, and debt included.
It's exactly. For airlines, which often carry substantial debt for aircraft purchases, financing, infrastructure, EV gives a much clearer picture of the true cost to acquire the entire company, or its actual economic size. The fact that JetBlue's enterprise value is more than 4 times its market cap immediately signals a very significant amount of debt on their books, which, as we'll explore, directly impacts their financial health and risk profile. It tells us that while the equity market values them at less than $2 billion, the total value of the enterprise, including those substantial liabilities, is over $8 billion. Huge difference.
That makes the picture much, much clearer.
Okay.
So building on that, looking at the stock's historical performance gives us crucial perspective beyond just one day. In the short term, we've seen some pretty notable gains leading up to this point. A significant perf week of 20.55%.
Impressive, yeah.
And perf month of 14.22%. That's some exciting recent upward momentum, which, as we'll see, ties into some of their recent news and market reactions.
Yes, those short-term rallies are certainly eye-catching, and they tell a story of recent positive sentiment, or maybe specific event-driven reactions. However, if we connect this to the broader picture, A glance at the longer-term performance tells a very different and frankly far more challenging story. It paints a stark contrast. The perf quarter is a modest 6.10%, okay? But then the numbers just drop sharply into negative territory. Perf half year is minus 21.86%, perf YTD minus 33.59%, perf 3-year minus 40.88%, perf 5-year minus 55.35%.
Oof.
And a truly striking perf 10-year of minus 77.60%. This clearly illustrates a tale of these short-term rallies popping up amidst significant, persistent, and you have to say deeply concerning long-term declines. The stock has lost a substantial portion of its value over extended periods. That suggests systemic challenges, not just temporary headwinds.
Yeah, that is a stark, almost jarring contrast. Recent optimism versus a decade of, well, value destruction, basically. Looking at their 52-week range adds to this picture. The stock traded between a low of $3.34. It's currently about 56% above that low, but it's also a significant minus 37% below its 52-week high of $8.31. What does this kind of extreme volatility suggest about investor sentiment and the stock itself? It feels like a real roller coaster.
It absolutely is a roller coaster.
Yeah.
And this volatility, it suggests several critical dynamics are at play here. Firstly, it points to a company undergoing significant transitions or one operating in a highly unpredictable environment, which is undeniably true for the airline sector, right?
Yeah.
The wide range between the 52-week high and low indicates that investor sentiment swings dramatically, often influenced by specific news, quarterly earnings, broader economic shifts like fuel prices or consumer travel demand. It implies that while there are moments of optimism, perhaps driven by specific strategic moves or unexpected positive news, there's also considerable underlying uncertainty, a fundamental lack of consistent confidence in the stock's long-term direction. Its inclusion in the Russell 2000 Index, the RUT, means it's part of a benchmark for small-cap companies. That reflects its relative size within the broader market and often suggests a higher risk-reward profile than, say, larger, more established companies.
All right, let's buckle up even tighter then, because we're about to dive deep into JetBlue's financial health. We're going to decipher the numbers that underpin everything we've just discussed, starting with their profitability and efficiency metrics, basically, their ability to turn operations into actual money. This is where the rubber meets the runway, as they say.
Precisely. Looking at their income and sales figures, JetBlue reported a net income of minus $386 million, a substantial loss, despite generating sales of $9.14 billion. $9 billion in sales, still losing almost $400 million. This immediately highlights a significant challenge. Even with billions in revenue flowing in, the company is still deep in the red. This isn't just a minor blip. It's a fundamental signal of a business struggling to convert its top-line performance into bottom-line profit.
A loss, even with billions in sales. Okay, that's a crucial starting point. Now, what do their margins tell us about how efficiently they're actually turning those sales into profit? Because gross sales don't mean much if you're spending more to make them, right?
You're hitting on the core challenge there. Let's look at their margins. The gross margin is 16.79%. Almost 17%. For an airline, gross margin tells us the percentage of revenue left after deducting the direct costs associated with operating flights. Think fuel, crew salaries, aircraft maintenance, airport landing fees, all that direct stuff. For JetBlue, just under 17 cents are left from every dollar earned after these immediate operational expenses. This is a particularly vulnerable margin in an airline because it's the first line of defense against volatile input costs, especially fuel. A low figure here means there's very little cushion before broader operating expenses start pushing them into deeper losses.
So even after covering those direct flight-specific costs, they're already running on kind of thin ice. And then when we consider all the other operating costs...
That's where the picture gets even more concerning, unfortunately. When we move down the income statement to factor in all other operating expenses, things like sales and marketing, administrative costs, depreciation, rent, their operating margin is minus 1.43%. Negative. A negative operating margin means that JetBlue's primary business activities are actually losing money before even accounting for interest on debt or taxes. This is a significant red flag because it indicates that their core operations are not sustainable as they are currently configured. It raises the profound question of whether their high-quality, low-cost model is simply too expensive to execute profitably in the current market. And the net result, as reflected in their overall profit margin, is minus 4.22%. It simply reinforces that, after all expenses are tallied, the company is consistently losing money overall from its operations.
That paints a very clear and yet challenging picture of current struggles.
Right.
How do these profitability struggles then manifest in their returns? Returns on assets, equity, invested capital, because these tell us how effectively they're using all their resources, right?
They align consistently with the negative margins, unfortunately. It's a coherent, if worrying, story. The return on assets, ROA, is minus 2.50%. Their return on equity, ROE, is minus 15.12%. And the return on invested capital, ROC, is minus 3.50%.
All negative.
All negative. What's truly critical here is how these numbers paint that consistent and deeply concerning picture of current challenges. Negative returns across the board indicate that the company is simply not effectively using its assets, shareholder equity, or the capital it has invested to generate profit. In fact, these investments are currently leading to losses. For a capital-intensive business like an airline, this is a major structural issue. It suggests that their fleet, their airport infrastructure, other investments are not yielding productive financial results. It directly highlights the uphill battle they face in achieving consistent profitability, as every dollar invested is currently shrinking rather than growing.
Okay, given that, well, daunting picture, let's talk about their earnings per share, EPS, and sales growth. This gives us a sense of their trajectory and maybe the immediate future. Their EPS on a trailing 12-month basis, TTM, is minus $1.09. And looking ahead, the expected EPS for the next year is still projected at minus Solaris on 93, with the next quarter projected at minus Solaris 53 cents. These are all still negative, indicating ongoing losses per share in the near term.
Yes. The immediate future, according to these projections, still anticipates losses. No way around that. This is a continuation of their significant past declines, as their EPS this year is down a staggering minus 136.99%.
Yeah.
And their past 3 to 5 year EPS growth is at minus 58.94%. This truly reflects a challenging, deeply unprofitable path in the recent past and immediate future. However, this is where it gets, well, really interesting, maybe confusing. There is a forecast for EPS next 5 years to be positive, at 32.15%.
Okay, hang on. This is a truly striking contrast. Persistent losses now and in the near future, yet a highly optimistic 5-year growth forecast. How do we, as listeners trying to understand this, reconcile those two very different projections? What would have to happen for that 5-year positive EPS forecast to actually materialize?
That's the million-dollar question, isn't it? And it speaks to the underlying assumptions analysts are making. The near-term negativity means the current cost structure and demand environment are just difficult to overcome quickly. It's baked in for now. The optimistic 5-year forecast likely hinges on the successful execution of their jet-forward strategy, which we'll discuss more, along with, a sustained recovery in travel demand, more stable fuel prices, maybe significant operational efficiencies finally coming to fruition.
So a lot has to go right.
A lot has to go right. Essentially, analysts are projecting a turnaround based on management's stated plans, but the immediate numbers show that turnaround is far from complete. If it's even truly begun to show widespread impact on the bottom line, it's basically a bet on future strategy overcoming current fundamentals.
And what about their sales growth? Are they at least growing the top line consistently?
Adding revenue. Well, their sales growth year-over-year TTM is minus 1.90%, and quarter-over-quarter sales are down minus 2.97%. So recent sales have actually been declining, which is another headwind for them. However, if you look at their sales over the past 3 and 5 years, there's a different story, showing 15.41% and 2.77% growth respectively. This means they've had periods of growth, perhaps coming out of the pandemic recovery, but more recently there's been a contraction, hinting at maybe softened demand or increased competition squeezing them.
And we also saw some interesting earnings surprises listed, specifically for their Q2 earnings on July 29th. EPS surprise was 50.19% and sales surprise was 3.02%. How do we interpret a surprise like that, a seemingly positive beat, when the company is still reporting significant losses? It sounds kind of counterintuitive.
It absolutely can be, yeah. And this is a classic market dynamic you see. These positive surprises indicate that while JetBlue did indeed report a loss and sales decreased year over year, the actual results were better than what analysts in the market had expected. In other words, expectations were set quite low, reflecting the challenging environment.
Okay, so they beat a low bar.
Exactly. Beating those lowered forecasts, even with a loss, can provide a temporary positive bump to the stock because it signals that the situation isn't as dire as feared, or perhaps that management is effectively managing expectations or maybe executing slightly better than predicted. It's important to distinguish between beating expectations and actually achieving profitability. Huge difference. It's like being told you're going to lose $100, but you only lose $50. It's still a loss, but it feels like a win against a worse expectation.
That's a great analogy. Okay, now let's shift to valuation multiples. If they're losing money, how is the market even pricing JBLU right now? Their PE and forward PE ratios are both listed as NA or unavailable. Why is that the case? Why no PE?
The NA for price to earnings, or PE, isn't just a technicality for JetBlue. It's a stark reminder that traditional profitability metrics, which most investors rely on, are simply irrelevant here. You can't use them. Since JetBlue is currently operating at a loss, it doesn't have positive earnings, the E in PE, to divide the share price by. This immediately tells you that you can't value a company on its earnings when it's actively losing money. It forces us to look at alternative, less direct indicators of value.
So if PE isn't an option, what alternative valuation metrics do we look at to gauge how the market sees its value? What else is there?
Well, we can use price to sales, or PS. For JetBlue, it's 0.21. PS is often used when a company isn't profitable, as it values the company relative to its revenue, its sales. A very low PS ratio, like 0.21, can suggest that the market views the company's sales as inexpensive relative to its stock price. Now, this could imply undervaluation in some contexts, but it must be considered in the context of those persistent losses we talked about.
Right. What about price to book, or PB JetBlue's, is 0.79? A PB less than 1 often suggests a stock is trading below its book value, meaning the market values the company less than the net value of its assets on the books. But again, how does that fit into the profitability context and their significant debt?
Yeah, a PB less than 1 can indeed imply the stock is trading below its book value, suggesting that the company's assets, if liquidated, might cover the share price, theoretically. However, it's not always a standalone indicator of value, not by a long shot. For a company that's unprofitable and carries high debt, as JetBlue gained, a low PB ratio might actually reflect the market's skepticism about the company's ability to generate future earnings from those assets. It could also suggest that a significant portion of those assets is financed by debt, which erodes the true equity value. So, while it appears cheap on a book value basis, the market isn't necessarily seeing a clear path to generating returns from those assets. It's wary.
Then there's EBITDA, which is 15.25, and EV sales at 0.90. These sound like metrics you'd often see for airlines, given how capital intensive they are, right, with all the planes and debt.
They absolutely are the go-to metrics for capital-intensive industries like airlines.
Exactly. If EBITDA, or enterprise value to earnings before interest, taxes, depreciation, and amortization, is particularly useful because it strips out the distortions of depreciation, which is massive for aircraft due to their high cost and long lifespan, and importantly, it incorporates the company's significant debt via the enterprise value.
Okay, so it's a cleaner look at operations before financing and accounting stuff.
Right. For JetBlue, with its substantial debt burden, EBITDA gives us a cleaner look at its operational cash flow generating potential relative to its total enterprise value. Now, an EBITDA of 15.25, that can be considered quite high. It suggests the market is placing a substantial value on each dollar of their operational earnings before those non-cash deductions and debt service. This could indicate the market is anticipating a strong future uptick in profitability, betting on that turnaround again.
Or, conversely, it might be a sign of overvaluation given their current struggles and the debt load. Depends on your perspective on their future prospects. The EV sales ratio of 0.90 reinforces the valuation relative to its total revenue, again, inclusive of debt.
Okay. All these numbers are painting a pretty consistent, if complex, picture, especially when it comes to profitability and how the market is struggling to value a loss-making enterprise. Now let's talk about liquidity and debt, their immediate financial stability and long-term leverage. This feels critical given the losses. Starting with their current ratio at 0.88 and quick ratio at 0.84. What do these tell us about their ability to cover short-term obligations? Bills coming due soon.
Both ratios being below 1 is a critical signal and, well, certainly a cause for concern, no doubt about it. The current ratio measures a company's ability to pay off its short-term liabilities with its short-term assets. A ratio below 1 means that current assets like cash, accounts receivable, inventory do not fully cover current liabilities like accounts payable and short-term debt. They don't have enough liquid stuff to cover immediate bills. This definitely points to potential liquidity challenges and a tight financial position in the short term, meaning unexpected expenses or delays in revenue could put them in a precarious spot. It's like flying without much extra fuel in the tank for unexpected detours or delays. Not much wiggle room.
That sounds like they're flying a bit too close to the ground, so to speak, in terms of their immediate cash position. And then there's their debt. Oh boy. Their debt to equity, or DE ratio, is 3.91, with long-term debt to equity at 3.58. Those seem like very high numbers, indicating significant reliance on borrowing.
A debt-to-equity ratio of 3.91 indicates that the company relies heavily on debt financing relative to equity. To put it simply, for every dollar of shareholder equity, they have almost $4 in debt. That's a lot of leverage. This significantly increases financial risk. It means that during economic downturns, periods of reduced travel demand, or spikes in operating costs like fuel, servicing that substantial debt can become an overwhelming burden. It directly impacts their ability to invest in growth, withstand economic shocks, or even make necessary operational adjustments. This very leveraged position suggests that a large portion of their assets are financed by creditors rather than shareholders, making them vulnerable to rising interest rates or tighter credit markets.
Okay, so to summarize the financial health part, it's clear JetBlue is in a challenging position. Persistent profitability struggles, significant debt, tight liquidity. That's a lot to contend with. Now let's switch gears a bit and look at the ownership structure of the company, what professional analysts are saying, and some of their most recent strategic moves. Trying to understand the full picture here.
Absolutely. Understanding who owns the stock and how insiders, the people running the company, are acting can provide additional layers of insight. You can reveal confidence or maybe concern from those closest to the company. Institutional ownership stands at 69.56% of shares. That's quite high and pretty typical for a publicly traded company of this size. It indicates that large investment funds, pension funds, other professional money managers hold the majority of the stock.
Okay, so mostly big institutions.
Right. Insider ownership is 19.96%, which is also a fairly significant portion, nearly 20%, meaning that those within the company, executives and directors, hold a notable stake themselves, which, in theory, aligns their interests with shareholders. They have skin in the game.
And then we get to the actual insider transactions, which can sometimes send mixed signals and be quite revealing about individual perceptions. You know, the inside scoop, maybe. The overall insider transactions value is slightly negative, minus 0.02%, indicating slight net selling overall. But let's look at specific trades, because that's where the potential drama unfolds, or rather, where we see real money moving and real, often contrasting opinions revealed.
Indeed. It gets interesting here. We have Ursula L. Hurley, the Chief Financial Officer, the CFO. She sold 15,000 shares on February 18, 2025, at $7.50 per share, totaling $112,500. This was a proposed sale reported on that date.
Okay, CFO selling.
But then, on the other side of the ledger, Nick Middle, who was a director on the board, took a much larger position. He bought 100,000 shares on February 4, 2025, at $6.14 per share. That totals $614,340. Big difference in dollar terms.
Wow, that's quite the contrast. A CFO selling a decent chunk and a director buying a much larger monetary stake just a couple of weeks earlier. Does one of these actions typically carry more weight in the eyes of the market, or is this just, standard individual portfolio management rather than a clear signal about JetBlue's future?
It absolutely sends a mixed message to investors. There's no single definitive interpretation, really. On one hand, a CFO selling shares might be interpreted negatively, right? Because they possess the most intimate knowledge of the company's financial health. It could suggest they see limited immediate upside. Maybe they're de-risking their personal portfolio or simply managing their own liquidity needs. Could be anything.
Sure, people sell for lots of reasons.
Exactly. But on the other hand, a director buying a significant chunk of shares, especially a larger monetary value like that, often indicates strong confidence in the company's future prospects and strategic direction. Directors are often involved in high-level strategy. So it's common for different insiders to have different financial needs or perspectives, or even different time horizons for their investments. So while it doesn't necessarily mean one is right and the other is wrong, it certainly creates ambiguity for outside observers trying to read the tea leaves of insider sentiment. Generally, the market tends to weigh open market purchases by multiple insiders more positively than sales because, well, people sell for many reasons, but usually only buy if they think the price is going up.
That makes sense. Okay. We also see high short interest for JBLU. The short float is 19.58%, with almost 57 million shares shorted, and a short ratio of 2.71. For those unfamiliar, what does this high short interest tell us about how a significant segment of the market views JetBlue? What does it mean when almost 20% of the float is short?
Yeah, high short interest like that typically signals that a significant portion of investors are actively betting against the stock, expecting its price to fall. They do this by borrowing shares, selling them on the open market, and hoping to buy them back later at a lower price to return to the lender, pocketing the difference. A short float of nearly 20% is considered quite high. It suggests a strong, pervasive bearish sentiment among a segment of the market who believe the stock is overvalued or that the company faces severe fundamental challenges like the ones we've been discussing. And the short ratio, often called days to cover, of 2.71 means it would take about 2.71 days for all those shorted shares to be covered or bought back, given the average daily trading volume. This indicates a relatively active short position that, if positive news were to emerge unexpectedly, could lead to a short squeeze. That's where short sellers rush to buy back shares to limit their losses, which inadvertently drives the price up sharply, sometimes dramatically.
Right, the shorts get squeezed out. Okay. Let's move on to what the experts, the professional analysts who cover the stock, are saying their recommendations and price targets. The consensus rating for JBLU is 3.81. On a scale where lower is generally better, 3.81 often implies a sell or underperform bias. That's certainly not a ringing endorsement from the professional community, is it?
No, it's certainly not. And it reinforces the cautious, if not outright pessimistic, sentiment we're seeing in other indicators. If we look at the recent analyst actions over the past 12 months, a noticeable and, frankly, concerning trend emerges. For example, UBS resumed coverage with a sell rating and a target of just $3 back on July 7, 2025. Raymond James downgraded from outperform to market perform in May 2025. Deutsche Bank downgraded from buy to hold back in March 2025, and they cut their target from $9 down to $7. Seaport Research Partners downgraded from buy to neutral in January. Buffett Securities downgraded from neutral to underperform, also in January 2025, with a $6.50 target. You see the pattern.
Yeah, definitely a downward trend there. So we're seeing a significant number of downgrades and sell ratings from prominent firms in late 2024 and early 2025, often accompanied by material price target cuts. This indicates a general and widespread bearish sentiment among analysts. What specific red flags in the financials do you think are driving this collective pessimism among the analyst community, especially when JetBlue keeps talking about its strategies?
That's a crucial question, yeah. The widespread bearishness among analysts, despite management's strategic plans, likely stems directly from those persistent and deep-seated profitability issues we've already highlighted. The negative operating and net profit margins, the negative returns on invested capital, the very high debt levels. These are fundamental concerns. They suggest a difficult, perhaps very long path to sustainable profitability. Analysts are paid to look at the long-term fundamentals, right? And when the core business isn't generating profit and it's heavily leveraged, it raises significant doubts about the ability to execute a turnaround, even with ambitious strategic initiatives. They're effectively saying, show us the profits, not just the plans. The numbers aren't backing up the story yet.
Okay, show me the money, basically. Now, for the narrative behind those numbers, recent news and strategic initiatives, what has JetBlue actually been doing? On July 29th, 2025, JetBlue released its Q2 2025 earnings. They reported a smaller than expected loss and actually topped revenue estimates. The company cited improving demand, strong operations, and continued execution of its jet-forward strategy. And this news, interestingly, initially caused the stock to take off, even with a reported loss.
Yeah, this is a classic example of how expectations management plays a significant role in stock performance, particularly for companies in a challenging position like JetBlue. While the company was indeed still unprofitable, the fact that their loss was narrower than anticipated and the exceeded revenue estimates led to that positive market reaction. It signals that the situation is perhaps not quite as dire as some had feared, or maybe the jet-forward strategy is being perceived, at least in the short term, as having some positive impact on mitigating losses. It's not a win, not really, but it's a less bad than expected result, which the market often rewards, especially when sentiment is already low.
In terms of partnerships and collaborations, JetBlue seems to be pretty active there. Their joint loyalty program with United Airlines, the Blue Sky Collaboration, was cleared by the Department of Transportation, the DOT, around July 30-31, 2025. Even though Spirit Airlines urged its rejection, this partnership is seen as potentially significant for driving demand, right?
Absolutely. These developments highlight the critical importance of strategic alliances and also adeptly navigating regulatory hurdles in the airline industry. The Blue Sky collaboration with United could be a pivotal demand driver, especially for a company trying to return to profitability. It expands their reach and loyalty program benefits for customers without needing their own planes on every route. It offers a way to compete against larger networks more effectively.
And we also saw the Supreme Court rejected American Airlines' appeal over a previous JetBlue deal back on June 30th, 2025. That hints at a complex regulatory environment they have to navigate.
Definitely. That Supreme Court decision indicates the dynamic and often litigious nature of competition and market consolidation within the sector. It showcases JetBlue's ability to, at times, win in those legal battles, which clears the way for certain strategic moves. It's part of the game in this industry.
Okay. Beyond partnerships, JetBlue has also been busy with operational and customer experience enhancements. Seems like they're trying to lean into their brand promise. They've announced new flights to Florida, Latin America, the Caribbean in mid-August 2025, a focus on Fort Lauderdale with new flights and their premium Mint service. They even brought the Mint experience to Orlando for the first time in June 2025 and launched their first flight to San Pedro Sula in Honduras. It sounds like a lot of investment and expansion in those premium offerings.
These are clear strategic moves, aimed at expanding their network into key leisure markets and enhancing their premium offerings like Mint. The goal there is to attract higher-paying customers, potentially improving their revenue per available seat mile, or RSM. Loyalty programs like TrueBlue Travel, launched in August 2025, and even fun sweepstakes like the one for Bad Bunny's residency. They're designed to boost customer engagement and retention, which ultimately supports demand.
Keep people flying JetBlue.
Exactly. And the focus on boosting customer satisfaction, as mentioned in early August 2025 news, suggests a crucial understanding that long-term financial gains often follow an improved customer experience, particularly important for JetBlue's chosen market position. The question, of course, is whether these investments will pay off quickly enough to offset their current profitability struggles. It costs money to add routes and enhance service.
And they're leaning into technology too, it seems. Enhanced checked bag tracking, new mobile features, leveraging Apple's share item location, plus expanding their Paisly travel offerings to include cruises, all geared towards customer satisfaction and, I guess, streamlining the travel experience.
Yes, these operational and technological improvements are crucial for any modern airline in today's competitive environment. You have to keep up. They aim to streamline the travel experience, reduce friction for passengers, and potentially enhance efficiency in the long run, making smoother. By making travel easier and more appealing, they hope to drive repeat business and attract new customers. However, it's important to remember that these initiatives, while forward-thinking, they come with significant upfront costs, and they need to translate into measurable financial benefits, which could be a slow process in a high-volume, low-margin business like airlines. They add to the operating expense line before they necessarily add much to the profit line. That's the gamble.
Okay, now for the flip side, and this is a significant part of the narrative we need to address. The challenges and cost cutting. A CEO memo surfaced around June 17, 2025. It signaled additional cost cuts and flight trims amid softened travel demand. That doesn't sound good. This memo also suggested that a money-losing 2025 is likely and break-even is unlikely. This news, understandably, led to significant stock falls when it came out.
Yeah. This internal communication becoming public is incredibly stark, and it directly contradicts some of the more optimistic narratives you might hear. It underscores the severity of the financial pressures JetBlue is facing and the difficult decisions they are making to manage costs in a truly challenging environment. The candid acknowledgement of a likely money-losing 2025 straight from the CEO isn't just grim news. It's a profound strategic signal. It tells us that the jet-forward strategy isn't some quick fix for profitability. It's a long-term, perhaps quite painful re-engineering effort. For investors, this fundamentally shifts the investment thesis from maybe growth potential to a focus on turnaround management and immediate cash preservation. Survival mode almost. It suggests that the immediate future will prioritize stability over expansion. And you have to ask, how difficult is it operationally to implement such drastic cost-cutting measures without alienating your customer base? Especially when you've built your brand on a premium low-cost model. That's the tightrope they're walking. Very difficult.
And external factors are always at play in the airline industry, right? It's so vulnerable to global events. We saw news about rising oil prices due to the Iran-Israel conflict back on June 14, 2025, and its immediate negative impact on airline shares across the board. Oil prices truly are a sword hanging over airlines' heads, aren't they?
Absolutely. Constantly. Fuel is consistently one of the largest operating expenses for airlines, often accounting for 20–30% of total costs, sometimes even more. So, geopolitical events that affect oil prices can have an immediate and significant impact on their profitability, directly eroding those already thin margins we discussed earlier. It's a constant, volatile variable that adds to the industry's inherent unpredictability. It makes long-term financial planning incredibly challenging for any airline, let alone one already struggling with profitability like JetBlue. An unexpected spike in fuel costs can wipe out any efficiency gains almost instantly. It's brutal.
Yet, despite all this negativity around JetBlue specifically, the broader industry context from August 2025 news reports that airline stocks are generally taking flight. Rising above cloudy earlier outlooks, airfare data was signaling improving pricing power. United and Delta were even noted as top S&P 500 stocks, indicating a sector-wide recovery for some of the big players. Meanwhile, Spirit Airlines, another low-cost carrier, is sounding the alarm on its future, potentially reducing low-cost options in the market. It's a weird mix.
It paints a mixed and somewhat paradoxical picture for JetBlue, doesn't it? While the industry as a whole might be seeing some recovery in pricing power with major carriers like United and Delta thriving, JetBlue appears to be an outlier, still grappling with significant and persistent profitability issues. The struggles of Spirit Airlines, another low-cost carrier, could potentially reduce competition in that segment, which might theoretically benefit JetBlue down the line. Fewer cheap seats available. However, it also highlights the precariousness of the budget airline model in this environment, especially for those unable to consistently achieve profitability. It raises a very important question. Can JetBlue leverage its high-quality service differentiator to escape the fate of other struggling low-cost carriers? Or will the underlying cost pressures pull them down further, even as some peers recover? Their path seems quite distinct from the broader industry trend right now.
Okay, speaking of external factors and how the company interacts with the world, let's move beyond direct operations to JetBlue's engagement in government relations. Lobbying. They have a consistent, really high level of spending on corporate lobbying efforts. It's a significant investment, quarter after quarter.
That's very true, and it speaks volumes about the regulatory landscape of the airline industry. It's just part of the cost of doing business. If we review their estimated quarterly lobbying spending from 2009 all the way to 2025, we see a consistent and substantial investment. For example, they spent $470,000 in July 2025, $750,000 in April 2025, $450,000 in January 2025. This consistent high-level spending has been ongoing for well over a decade, often reaching $500,000 or more per quarter. It adds up.
And what are the key issues they are consistently lobbying on with that kind of investment? What's important enough to spend that kind of money on repeatedly year after year?
The primary lobbying issues are consistently, number one, aviation airlines airports. That covers a vast array of topics. Airport slot allocations, air traffic control modernization, safety regulations, you name it. Then there's Homeland Security. That directly impacts airport security protocols, passenger screening, things that affect operational efficiency and the passenger experience. Think TSA rules.
Right.
And surprisingly, maybe, banking is also a key area. That's likely related to financing aircraft, managing all that debt we talked about, and broader financial regulations impacting their treasury operations. Occasionally, other issues pop up too: trade, defense, budget appropriations, taxation. This comprehensive focus tells us a lot about the strategic priorities of the airline industry. It's deeply intertwined with government policy and regulation. You can't escape it.
This really raises an important question. How much does shaping policy truly impact an airline's bottom line? Because that's a lot of money to spend consistently, quarter after quarter. Is it worth it?
It's a significant indicator of just how vital government relations are for an airline. It has to be worth it or they wouldn't do it. This consistent, high-level lobbying tells us that the airline industry is not just influenced by, but heavily reliant on, government policy and regulation for its very operations and profitability. Policies related to airport access, noise restrictions, air traffic control infrastructure, environmental regulations like emission standards, consumer protection rules, even antitrust decisions on mergers or partnerships. They all directly impact operational costs and revenue potential. By actively lobbying, JetBlue, like other airlines, aims to influence legislation and regulatory decisions that can directly affect their competitive landscape, operational efficiency, and overall profitability. It's really an essential, proactive part of doing business in such a pervasively regulated sector. It's a cost of doing business that can yield significant returns by either avoiding punitive regulations or maybe gaining strategic advantages.
Okay, so lobbying is key. Beyond lobbying, JetBlue also engages in government contracts, selling services to the government. How significant are these for their overall revenue stream? Is it a big piece of the pie?
Their government contracts are quite variable and generally not a primary revenue driver, not compared to ticket sales. But they offer some diversification. We see federal grants, sometimes loans, and purchases from 2021-2025, mostly from the General Services Administration, the GSA, and the Department of Defense, DoD. For instance, there was a $372,982 contract from the DoD in July 2022, and other significant contracts like $89,000, $152,000, $127,000, $57,000 from the DoD in 2021-2022. It's also notable that there are recurring $0 contracts from the GSA, which might signify administrative reporting for services provided under blanket agreements or perhaps even non-monetary agreements for things like preferred status for government travelers. Hard to say exactly without more detail.
Okay, so while these aren't the main ticket sales filling their planes, what strategic role do these government contracts play for an airline like JetBlue? Is it about more than just the immediate dollar amount?
Absolutely, yeah. It's likely about more than just the immediate revenue. While these contracts aren't a dominant source of revenue for a commercial airline of JetBlue's size, they can play a supportive strategic role. They represent a diversified, albeit small, revenue stream that can offer a degree of stability compared to the more volatile consumer travel market. Government business can be steadier. Contracts with the DoD, for instance, often involve transporting military personnel or supplies. That provides a reliable source of business that might not be as susceptible to economic downturns or seasonal fluctuations. GSA contracts could involve pre-negotiated travel services for federal employees. Again, steady business. Maintaining these relationships and fulfilling these contracts can enhance an airline's perceived reliability and maybe open doors to other governmental opportunities in the future. It's about leveraging existing operational capacity for additional income and maintaining important institutional relationships, even if it's supplementary to their core business.
All right, we've covered a lot of ground today, analyzed everything from stock performance to profitability, from insider trades to strategic news, and even their government interactions.
On one hand, you have this self-described low-cost airline that's striving to maintain a unique market position by emphasizing high-quality service and customer experience. That's their brand. On the other hand, the financial data reveals significant and persistent financial losses. Consistently negative operating and net profit margins, exceptionally high debt-to-equity ratios, and those negative returns on assets, equity, and invested capital. This clearly signals a company grappling with severe profitability challenges and substantial financial leverage. It's undeniable. The core question that emerges is whether their chosen business model is inherently sustainable, given the costs of delivering that high-quality service within a low-cost framework, especially in today's environment.
Yeah, that seems to be the crux of it. Yet despite those stark financial struggles, they're clearly not just standing still, waiting for things to get better. We've seen them actively making strategic moves, forging new partnerships like the Blue Sky collaboration with United, expanding into new routes and premium services like Mint, investing heavily in customer experience and technology. And these efforts, interestingly, sometimes result in those short-term stock gains, even when they're still reporting losses, demonstrating how market expectations and news flow can drive short-term price movements, perhaps more than underlying profitability at times.
This highlights the dual pressures JetBlue is under. It's a real bind. The urgent, critical need to manage costs, as evidenced by the CEO's candid memo about additional flight trims and likely losses for 2025 in an environment of softened travel demand. Survival mode. At the same time, they are trying to grow and differentiate through new routes, enhanced loyalty programs, and superior customer service. Investing for the future. It's an incredibly challenging balancing act between cutting expenses to survive the present and investing for future growth to assure long-term viability, all within a very competitive sector. The success of the JetForward strategy really hinges on their ability to execute this delicate balance, transforming those strategic investments into tangible, sustained profitability. That's the goal.
And they're certainly not immune to broader industry headwinds either, as we discussed. We talked about fluctuating oil prices, which directly impact their massive fuel costs, the ongoing regulatory challenges like that Supreme Court case or Spirit Airlines potentially shrinking, hinting at pressures on the low-cost segment specifically. These external factors can quickly disrupt even the best-laid plans and exacerbate existing financial vulnerabilities, can't they?
Precisely, yeah. If we connect this to the bigger picture, the external environment adds another layer of complexity, another challenge to JetBlue's internal struggles. The success of their JetForward strategy will be absolutely crucial for reversing those negative financial trends. It seems like their main hope right now. The fact that Q2 earnings, despite being a loss, were better than expected and attributed partly to this strategy, that suggests it might be their most viable path to a turnaround. Maybe it's starting to work. But executing that strategy effectively while under significant financial pressure, high debt, and in a volatile market, that will be a true test of their operational resilience, their strategic foresight, and their ability to differentiate themselves in a brutal airline industry. It's a tall order.